In this video, traders, let's talk about being positioned before the breakout. Stay tuned. Talk a little bit about being positioned before the breakout. So I have a daily chart up here of the DAX, and our DAX equivalent is German 30 in this spread betting account, GER 30, and you can easily you just bring up whatever market you're looking for just by clicking on the chart at the top there and then scrolling through and picking the market that you're looking at. But we're looking at German 30 at the moment, and the reason I'm picking this is because it's one of these perfect scenarios where the breakout looks so tempting. And listen, we all know the breakout and how the breakout works. Textbook 101 says, hey, when the price breaks above the high, you buy it and you ride it. And when they work well. But a lot of the time, breakouts, especially in currency pairs, in the indices, broad indices, in some thicker commodities like your crude, like your gold, these thicker instruments sometimes don't break as cleanly and as crisply as we would like, as the textbook says they should. This is where we have to be clever and we have to position a little bit differently. We have to take into account the asset class we're trading, the market we're trading, the environment we're trading in. So let's fast forward quickly. DAX 30. Pushing up from the coronavirus. This is not coronavirus lows. Coronavirus lows are way back there. But this is a kind of dip back out. And let's put it into perspective so you can see where we are depending on when you're watching this video. Those are what I'm calling the coronavirus lows. We've pushed back up. We were stagnating. A little bit of a dip. And now we're pushing back up. That's normally quite a bullish sign. When you dip and then push back up, that's quite bullish. What isn't bullish is the fact that we're really struggling with this resistance level here. And we've got a little bit more to go to get to the prior highs before our coronavirus hit. Anyway, what I want to talk about pure from a technical perspective is this. This is a key level. You'd probably be drawing exactly the same level as me, give or take, a few points, but it's a high. You're looking for it to break. So one way to position for this, and if we kind of zoom right in and go, right, this is the daily move, is we go, okay, here's the high. We're going to buy a break of the high. Now, if you'd done this on this candle here, let's get the crosshairs out. If you'd done it on this candle here, you're going to be in a little bit of heat because you probably bought it as it broke through the high here at kind of 13,300. And price has come back to 13,180. Now, if you've got a wide stop, that's fine. Maybe your stop's below here. You're looking for a multi-month move. And that's okay because the risk-reward ratio works out okay. You go, right, my stop is 300 points. I'm looking for a 1,000-point move. It's more than a 3-to-1. Ticking my boxes, happy to do that. But if you're a bit more active, and let's say you're looking for a 3 or 4 day move, maybe a week move, you probably don't want to have a 300-point stop because that's probably the sort of order of magnitude of move you're looking for. I mean, if you're looking for a breakout from here, you're probably saying, all right, where are we going to break out from 13,300? Could we go to 13,600, 13,700? That's the sort of thing that looks okay for an initial pulse. Now, will it continue afterwards? Who knows? That's a separate trade in my eyes. The initial break is one trade, then you've got the congestion, maybe the backfill to the break level and go again. That becomes under a separate wrapper for me. So I like to look at what's the initial pulse breakout. How can I trade that? So if we bought that there, we're taking too much heat really. So one thing to think about and consider is to be what I call be positioned before the break. So this is, something, I guess it's not really a textbook way of doing it because most people are going to say to you, hey, you don't want to take the break until you see them commit. And in many circumstances, that makes perfect sense. But when you're in certain scenarios where you go, okay, you never know a break's going to work anyway, right? We don't know this. And that's why we have to risk-reward ratio, have our stop loss in place. And oftentimes we can get frustrated, guys, and we're trying to take a break, trying to take a break. It can annoy us because we get stopped out. And then it finally goes. And by that time, we've already been stopped out 3 times. The trade's pointless anyway. So they can become a little bit frustrating. Now, under certain conditions, fine. Take the break, trade the break, do it. Coming off the low, if you're early in the game, taking the break from there, you've got a good trade. But if you're taking a break late in the day, I don't think on some circumstances, I think you've got a negative expectancy. So how do you turn that into a positive expectancy and utilize the power of the momentum from the break? So one thing to do is to look to position, where can I position for this break? And you've got to start thinking of that way before the break. This way you become a little bit more advanced and start thinking several moves ahead. One step ahead of the crowd, guys. You need to be thinking about preempting the break, as we're kind of recovering from here. So you know, if you are, let's say you're here, let's say we're looking at this, right? This is our range bound environment. Market pushes below. At that point in time, you're thinking, hey, well, could we revisit lows? However you're trading it, you could have some sort of thesis. Who knows what a thesis is? As we start to come back up through and kind of sit around here, especially when we're breaking up here, now you start to think, well, you know what, actually, we didn't find any sellers when we broke below that lower range. We didn't find any sellers when we broke below the summer low, and now we're back up. We've got a good chance. So you've got to start to then consider, where do I want to get in for the break? Now, do you have a bid under the market? This is exactly how I'm playing this at the moment. I've got a resting bid under these kind of levels here. Just under that 13,000 level, this tight little area there. Argument could say I should have it a little bit lower, but I think this is a high tight flag. I think if we get a little pull lower, fine, then we'll push off. I may not get it, but that's because I hadn't positioned before. The purpose of positioning before the break means that however you take this, let's say you take that little mini breakout, 2-day breakout there on that high, for argument's sake, right? You then in a nice position where you treat that as a separate trade, and you say, right, that's my trade. I'm going to have it below a 2-day low, my stop. I'm going to make the assumption that we push up to here. You are now in the most powerful position you can be in a trading position. You have lots of cushion, lots of profit in the bank, so to speak. Yes, it's not realized yet, but it's unrealized. So you have that psychological cushion, and you're in a position now where if it breaks, great, you're going to get that momentum, you're going to get the extra juice from the deal. If it doesn't, you might have to give some back. But the key, and this is where it gets so useful, guys, is you can sit through all these fake outs and not even be phased. Yes, your P&L might be up a bit, down a bit, but it's not as impactful as the trade being positive, hugely negative, and you're oscillating around that P&L, red and green on the trade. It's far more better of a powerful position to be in. So if you can position at any point in time, thinking ahead, where can I position long? It's a little bit early, admittedly, but if I can position long earlier and be there ready and position long before it breaks, that could be a much better position to be in. And thinking about it, you also can then set and forget, because once it kind of goes off and it starts to sit that, you don't have to have that psychological impact of, is it going to break, is it not going to break? And that is why I am trying to bid under the market a little bit here myself. I'm not involved in this. I should have been positioned before the break, trading other things. This is just kind of an outline, guys, of what's happening. This is a great example, because I know a lot of you trade the DAX. And by the way, who knows if it's going to break? Nobody knows. But this is why we try to position before the break, because if it doesn't, it pulls back. You're probably going to give back half. You take half your profit. You look for the next trade. But if it does break, you've got that extra momentum, that final little bit of juice that you can then start to scale it out into that kind of break from your profit earlier. So the number one point is think of trying to position before the break. Think multiple steps ahead. Where could this price now go after it's done this? Could it hit that high? Well, if it does, where do I want to be positioned? And if you can't position, don't force it. If you can't find a position, don't force it. But then when it's about to break, again, kind of look at it. I like to look at it as, I don't want to buy the break. If we get one more little dip below these lows, I'll have a nibble, and then I'll be positioned. Not quite as nice as here for the break, but at least if it pulls back up to the highs, you know, maybe I'll have a 300-point cushion, so to speak, and it can oscillate up and down, break through and back, and I'm not going to be too phased by it, rather than buying the break here. So something to think about, guys. If you see a really good level to the upside or downside, you know, think multiple steps ahead. How can I position early, safely, obviously managing risk, so I can be in the deal as it's going to break? So it's not so important if it breaks or if it doesn't break. Something to think about, guys. If you enjoyed it, thumbs up is appreciated. Bye-bye.